How is an IPO price determined before a stock goes public? Imagine you're about to buy a ticket to a concert that hasn't happened yet. How do you know what the ticket will cost? The same idea applies to an initial public offering, or IPO. The price of a company's stock before it starts trading on the stock market is not just pulled out of thin air. It is carefully calculated through a detailed process involving the company and financial experts called underwriters. First, the company's value is assessed. This means looking at how much money the company makes, how fast it is growing, and how it compares to similar companies that are already public. They analyze financial reports, earnings, assets, and future potential. Based on this, they come up with an estimated value of the whole company. Then, they divide this total value by the number of shares they plan to sell. This gives a rough idea of what each share might be worth. Next, the underwriters start a process called book building. They reach out to big investors like mutual funds and pension funds and ask them how much they would pay for shares within a certain price range. These investors submit bids, and the underwriters see how much interest there is. If many investors want to buy at a higher price, the company might set the IPO price higher. If interest is weak, they might lower the price to attract more buyers. Sometimes, instead of using the book building method, a company might choose a fixed price. This means they decide on a set price for each share before talking to investors. But this approach is less common because it doesn't allow for as much feedback from the market. Market conditions also play a role. If the stock market is doing well and investors are eager to buy new stocks, the IPO price might be higher. If the market is shaky or investors are cautious, the price might be lower to make sure the shares sell. All these steps help balance the company's need to raise enough money and investors' desire to buy shares at a fair price. The IPO price is important because it sets the starting point for trading. It influences how the stock will perform once it hits the market and affects options trading, which depends on the stock's initial volatility and price. In short, the IPO price is determined by a mix of company valuation, investor demand, and current market conditions. It's a careful process designed to find a fair value for everyone involved before the stock begins its journey on the stock exchange.